Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. Welcome back. It is so good to have you with us today at Money on Tap. My name is Seth Krussman.
And I'm Ben Brayshaw.
So today, we are going to be dipping in, wading above, well, we're going to stay afloat, but we're going to get into the S&P 500 index, and we're going to talk all about this index, the pros, the cons, the places that you need to just be aware of as an investor, because you're probably thinking, hey, this thing's a totally equally weighted, diverse place that I can be putting my money, because everywhere I turn around, everybody says S&P 500, right?
Everyone says buy passive S&P 500, and everyone thinks they're buying something, and they're not really sure what they're buying. And I think I'm excited to expose a little bit of this.
That's a strong statement. I like to get our day started that way. And if you're new to us, welcome. You can actually reach us at 855-226-8551 or info@yourmoneyontap.com. And as I say that, I realize that maybe you're not new to us. And maybe you call us on the regular. You're still welcome to use those numbers. They haven't changed. And so one of the things that we're going to start off with in this show is we're going to start off with some money in the news. Tesla, look out, because Amazon has just put you on notice. Amazon now has purchased Zoox. And if you're not familiar with Zoox, what is Zoox? Zoox is one of the innovators in self-driving cars. And, it's a startup that they picked up for $1.2 billion. Just a couple pennies out there for Amazon.
It's like nothing for them. I think they just feel like, hey, let's play in the car market for a little bit. I mean, it's interesting because Musk called Jeff Bezos a copycat, which is pretty funny. I thought that was interesting. But Zoox has some pretty interesting, technology that they feel is cutting edge for basically how it looks at the surroundings and the environment and the movement. Or I don't know all the whatever it is that it does that's so uniquely different. They tried to describe it. It wasn't really within my ballpark of expertise, but Zook's goal was to develop the robo-taxi. That is what they want to do, a self-driving taxi, and Amazon wants to move this into self-driving delivery, which is very interesting.
Yeah, so why would Amazon be interested in this? It's $1 trillion reason at the moment.
Because they show up to our house 5 times a day.
Oh my gosh. So are you saying that Amazon drivers need to beware because there could be,
Amazon could do a little bit with the organizational piece of delivery. I'll put that out there for them. So.
Okay. Well, I do like this is totally off topic, of course, but there was the delivery that was drone delivery. That was a while ago. Money in the news, like last year, maybe.
I have never gotten a drone delivery yet.
I'm still waiting for mine. Things keep showing up, but you're right. I haven't seen it show up by drone.
You just wonder, completely off topic, if some guy at Amazon says, I want to have the coolest, greatest drone in the world, and let's pretend we're going to do drone delivery, and we'll write it off as a business expense, and we'll fly them around corporate headquarters. But anyways, this is interesting because the article goes on to basically talk about the fact that Amazon, Tesla, and Google are literally seeking the self-driving supremacy world. These 3 companies are fighting hard for it, and it is definitely the wave of the future.
Amen to that. And with that, we're going to move on to the next article for you today. A couple of them, actually, that are we're going to run in tandem here. And This is, again, Tesla. What is it? Why are we talking so much about Tesla today, Ben?
Well, just because it happens to be in the news.
Okay.
Well, Tesla is just announced a 5-for-1 stock split. So they're going to, if you have 100 shares, they're going to give you 500 shares. And this is big news because Elon Musk has said repetitively that his stock is overpriced. And that has been something that he's talked about, either they do a cut and so forth. Now, when you have a stock split, there is no change in value. The company is worth the same whether you have 100 shares or you have 500 shares worth 1/5 the value. The company itself has not done anything specifically to increase the value of the company. Therefore, the shares should be worth exactly 1/5. But the understanding is that if they do a stock split, it gives more of an opportunity for people to own this.
Ben, that just makes no sense to me, though, because if you're telling me that I have one share and then after a stock split, I've got 5 shares. 5 is better. 5 is more than 1.
Yes, it is, but it is 1/5 of the value. So, this is interesting. I mean, there are so many opportunities to own stock, and you don't have to necessarily, split your stock. You can buy partial shares at different houses. I think Goldman Sachs offers that ability, and so forth. So this isn't
Schwab.
Schwab. This isn't entirely necessary, but. What's interesting about stock splits, and one of the arguments around not doing stock splits versus doing stock splits, is that a really high expensive stock, like Tesla's $1,400-$1,500 a share, and it's less likely, or there's less volatility in a higher price stock theoretically, because someone who's putting a few $100s in a month into their brokerage account can't buy Tesla that way. They've got to save up for a few months to buy one share. Now, when it drops way down, well, they can trade it. They can trade it more actively, and that's something that may create volatility in the share price and a concern for some investors.
That's true. Yeah, if you were to try to do the same thing with Amazon, if you were to try to buy Amazon, you're looking at a 6-month period before you'd be able to pick up a share of Amazon if you're saving $500 a month. And certainly that might deter me a little bit from 6 months of my savings buying one share versus, being able to pick it up here and there. And I like what the brokerage houses have done with that, making it more readily available with partial shares. But I think one of the things there that I look at is their employees and a lot of their employee stock purchase programs that they have, and lowering the price there can make that more readily available for the employees to buy.
Yeah, absolutely. I mean, I'm pretty much in favor for a stock split. I think that it's good for the overall market sometimes to have a stock split to allow activity to occur, because there's a lot of people that want to get invested, and if you want to open your company to a broader range of investors, stock splits make it easier.
I agree. And with that, there's another stock split. This is not the stock split show. It just happened to show up on the radar with Apple. But I love the names that we're talking about today. We've got Amazon, we've got Tesla, we've got Apple. And Apple is doing a 4-to-1 stock split here. And it's nothing that they haven't done before. I want to say it was, 2014 and 2006. They've done this previously, but what's different here when we say Apple's doing a stock split is that Apple is not only in the S&P 500 index, it's not only in the NASDAQ, it is also in what?
The Dow.
That's right. So this is an S&P 500 show because we're going to talk about we're going to loop back with some more Apple down the road here and what that looks like in comparison, but from the S&P 500 index to the Dow, but they are not created the same, the Dow and the S&P 500. So it makes a big difference when there's a stock split with a stock in the Dow because it is a price weighted index. What does that mean?
Well, the thing about how they measure and why all these indexes or indices are so relevant is because of how they're looked at. And when you're a price-weighted index, it's much more complicated because it's basically the higher your share price, the more impact you have to a price-weighted index. So when you cut your share price, it's going to have less impact. So Apple, who's basically number one or number two, I think they're number one in the Dow right now, but they will be like middle of the pack at best when they do a stock split. So they will have less impact on the Dow moving forward, but not the S&P. It doesn't have the same impact here. What's interesting is that with Apple, this 4-to-1 stock split as of August 24th, 2020, if you own Apple, you're going to get four shares for every one. I think this is their fourth or fifth split. They were added to the Dow back in 2015. So, they replaced AT&T, if my memory serves me correctly, and they've had, I think this will be their fifth split. And last time they split was in 2014, which was a 7-for-1 split. So that's kind of interesting. Apple has repetitively done this. This is part of their culture. It's part of their story. And they have done this because they believe there's so many people who want to be part of Apple. And they've always wanted to it's been a goal to always make it an affordable stock price. So that is kind of an interesting thing. And there's some other dynamics around this that will really play into our show moving forward. And I'm really excited about that.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Get ready, because when we come back, we're going to be talking about the S&P 500 index, folks. It's going to be a lot of fun.
Hi, my name is Ben Brayshaw, one of the co-hosts of Money on Tap. If you have questions when it comes to your retirement and are looking for a personalized solution, contact us at Brayshaw Financial Group. In today's volatile stock market, we can help you plan to find your successful retirement solution. Am I saving enough? Am I saving into the right places? Do my investments match my appetite for risk? Do I have a tax strategy that is going to help me keep more of what I earn? How can I maximize my Social Security income? If you are like most people, you are getting closer and closer to your retirement and may be wondering if you're taking the right steps. If you're in retirement, you may be wondering, am I maximizing my income while preserving my estate and caring for my family? We talk about all things financial in what we call three-dimensional investing, putting a plan around your financial future. If you feel that now is the time to start getting the answers to some of these questions for your own situation, give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices throughout New England and across the country. We would love the opportunity to show you how we can help. There's absolutely no cost or obligation just to meet with us, and we welcome you to our office. Call us at 855-226-8551.
Now back to Money on Tap with Ben and Seth.
Welcome back. You are listening to Money on Tap, and we are about to start the S&P 500 show. Okay? So you can reach us at 855-226-8551 or info@yourmoneyontap.com. Why is this such a big deal for you? Let's talk about some of the history first so that you can understand why would we even have this as a topic on this show.
Yeah, this is one of those things, Seth, where everybody is an index investor, it seems like. When we walks through our office and says, yeah, I have the 401k, I have the S&P 500 index, and I own the VOO or the IVV or the SPY, and that's all they own sometimes. I mean, which is a little scary. And we use some of these ETFs. We've used the SPY and the IVV right now. I mean, those are two that we've used and are using. We're not recommending those for anybody, but I would say that they're kind of becoming commonplace for a lot of people because they're saying, hey, I want to invest in the market, and I'm really not sure what to buy specifically, so I'm just going to buy the SPY or whatever and get general market exposure on this large cap, big boy blue chip companies.
It is truly a backbone of investing if you are in the market. And that's one of the biggest pieces that we can take here is when taking a look at the broader market and how is the market doing. It is the go-to. The S&P 500 is the go-to for anybody out there that's having a discussion around the market. And it's important for you to understand what's under the hood here. We'll get there, but before we do, Where does it even come from? When we get this, when we say S&P 500, also referred to as the S&P, it was introduced by Standard & Poor's in 1957 as a stock market index to track the value of the 500 large corporations listed on the New York Stock Exchange and the NASDAQ composite. A couple of things we'll get to there a little bit down the road. Collection of stocks make up the S&P, and it's intended to represent the overall composition of the U.S. economy. And are there more than 500 companies that are publicly traded within this band, this tier? Yeah, there are. You can take a look at the Russell. Okay, Russell 3000 pulls in 3,000 companies that are, pretty much these larger cap, and then they break that 3,000 into some small cap and some other caps inside there as well. So there's some different ways to take a look at the U.S. economy as a whole.
Lots of caps going on here, Seth.
Woohoo!
But I think the thing is one thing that's really good about the concept or the conversation around the S&P 500 is that we have real conversation about 500 to be potentially the largest companies in the U.S. And so it really gives us an indicator of where the U.S. economy and the larger company space is moving.
Is it a perfect conversation? Is it a perfect index or a perfect view of what is happening in terms of our economy? You could argue one way or the other.
As we look at these hidden risks in the S&P 500, and as we go through this today, I think we're really going to have a lot of people say, I agree or I don't agree with this being an issue or a concern for me. We're also, for the people who feel maybe that these hidden risks are relevant for you, we're going to have some solution pieces around how to address some of the risks that are associated with it. But as we go through the S&P 500, and Seth, you're talking about the history, I think one of the pieces about the S&P 500, because it's kind of mysterious, right? I mean, with the Dow, we have 30 stocks. You can look them up, you can read about them, you can tell you, so forth. But the S&P 500, Standard & Poor's does not put a list out of the 500 stocks. Okay, and I think that's where we start getting a little bit in conversation of like, well, then who's in there? I mean, who you don't have a list,
and how much of who's in there, at what level is in there?
Right. I mean, it's a little bit, I don't know, concerning on some level when you say, hey, we got this index the Standard & Poor's is doing, and they're not going to tell you a little bit about it, but they're going to take the company's market cap, which they, base it on, they base it on a couple different things, which is a little ambiguous, but they basically take the publicly traded shares and they do the math around that on the market cap. And then they divide it by the total of all market caps. But we don't know what the total of all the market caps are because that divisor is unknown because they don't let us know what the S&P 500 is truly made up of. So how, when you buy the S&P 500 index fund in your 401k, do you know that you're even buying the S&P 500?
You don't.
Bingo.
That's it. You really don't. And there's as close as you can possibly get is really the best solution that anybody out there creating the tradable indexes that we've talked about, that Ben's talked about, the tickers. That's as close as you're going to get, folks. And some of it's pretty darn good, right? Some of it is less. That's the deviation off of these. Some of them are less near to the index.
Yeah, but I mean, this speculation around the different holdings is just it's astronomically broad because the thing is it's the 500 largest U.S. companies. Well, we all know that Amazon, Netflix, Google, Microsoft, PayPal, whatever. We know that these companies are in there just because they're definitely in the top 500. But some of the calculation methods that they're doing leave the kind of the last few, last 50 or 100 or so, is kind of ambiguously in question.
So it's not the same method, but you are in kind of the same place when you talk about the Dow, right? The Dow 30, which has kind of been that retail investors index that everybody's kind of looked at, the bellwether out there for those 30 companies. But I mean, there's still some proprietary information that you're going to get close, but you're not going to have the exact number on.
Right, and they do. I mean, they kick people out of the Dow too. I mean, it's like GE was kicked out of the Dow after what was it, 109 years or something of being in there or some crazy thing, and but the question mark was, should they have been kicked out?
Well, they didn't ask me, so I don't know.
They didn't ask me either. But, these are things that these indices kind of have. We base a lot of trust and, belief in the movement of the market based on these indices. And honestly, there's so many pieces to them that we don't understand, don't know. And, how much market manipulation goes into indices? Like, we believe so much in it. Like, hey, the market's up today because the indice says it is. But then you go into kind of one piece that's very, very interesting. Okay. Now, why is the total dividend yield in the S&P 500 just 1.8%? But according to FactSet Screen, the average company in the index is yielding 3%.
Well, that has to do with the market capitalization and the weighting.
Darn right it does. And so, so when you start really breaking down these different pieces, you're saying to yourself, how am I doing? We have benchmarks and we have all these different pieces that we compare and we say, hey, this is how we invest and whatnot. But if you buy the S&P 500 index of any one of these, and then you say, how is it compared to the S&P 500? I mean, it's just very interesting how they can be completely, they're trying to mimic it, but they can be off.
So key takeaways on these pieces are that the S&P 500 index, or the Standard & Poor's 500 index, is a market capitalization weighted index of 500 largest U.S. publicly traded companies. It's a float weighted index, meaning the company's market capitalizations are adjusted by the number of shares available for public trading, only public trading shares. And the index is widely regarded as the best gauge of the large cap U.S. equities. And that's debatable, but as a result, there are a lot of funds out there that are designed to track the performance of the S&P. I don't know how many 401ks out there don't offer something that is either in a mutual fund form or an ETF form that is designed to track this, but if yours doesn't, call us because it should be there somehow, some way. And we're going to get into what is the breakdown? What are the specifics? Why would there be any kind of a takeaway here that you should be cautious as far as your understanding of what's in that? You are listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're going to take a quick break and we'll be right back with more on the S&P 500 index, how is it put together, and what you should know about it. Hi, my name is Seth Krussman, partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. One of the biggest concerns and largest expenses people face today is taxes. Without thoughtful planning, taxes can destroy future retirement dollars, eliminating the possibility of a timely retirement or dreams of what you want retirement to look like. If you're like most people, you're getting closer and closer to retirement, and you may be wondering if you're taking the right steps. Will my income be enough? Will rising taxes force me to give up my dreams? How does inflation factor into all of this? These are real concerns, and you're not alone. Putting a plan around your financial future is what we do. If you have questions when it comes to your financial security, and if you're looking for a personalized solution, contact us at Brayshaw Financial Group, 855-226-8551. It's time for you to start getting answers to your questions. Headquartered in Bedford, New Hampshire, Brayshaw Financial has offices across the country. We'd love the opportunity to show you how we can help. There's absolutely no cost or obligation to meet with us. Call us at 855-226-8551. 855-226-8551.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Today, we are talking about the S&P 500 index and one of the most widely quoted American index because it represents the largest publicly traded companies in the U.S., right? 500 of them. And it really focuses on the U.S. market's large cap which is capitalization. When we say cap, that's what we're talking about. Sector. It's also float weighted index, meaning the company market capitalizations are adjusted by the number of shares available for public trading, and it goes up and it goes down.
Seth,
those are the facts.
Seth, you were right on, man. You just led me right into where I wanted to go. I think the thing about the S&P 500 is that when it was introduced, as you mentioned, in 1957, during its first decade, it rose nearly 700 points. Okay, and then between 1969 and 1981, it eventually fell to under 300. Okay, now the S&P 500 is trading between 3,300 and 3,400 today, so that's a significant difference from the 300 levels. If we all want to think back to 2007, which most people don't, okay, beginning in October, it bottomed out in 2009 to about 57.7% the S&P lost. So you would have lost close to 60% of your money in the S&P 500
over a roughly 2-year period.
Yeah, barely. So that's what's scary about that, is that it is such a popular investment, right? I mean, it's pretty much the mainstay conversation for the vast majority of people when they look at their 401k. And you say, well, why is that with an indice that has dropped 60%? And that's because over the last decade, we've seen it reach its all-time high, and it's climbed over 400%. So in the last 10 years, if you didn't own the S&P 500, you didn't see those kind of returns. Now, 400%, it's like, well, that's a decade, that's 10 years. Well, if you double your money in 10 years, that's 7.2% rate of return. So if you were to look at that bottom and you look at the top, I mean, we have just had an astronomical level of growth in there. But why is that? And why is it that we're talking about hidden risks potentially in the S&P 500 and in the investment in these types of popular mainstream investment items? And that's because of a lot of the unknown factors. I think, Seth and I, we talk to people all the time about how when you own the index, you really don't necessarily own 500 companies. That's the thing. When people buy indexes, they think they're getting this broad range and very diversified, kind of allocation. And I want to bring to the forefront today kind of a couple of the holding patterns of kind of the top 3 indexes we hear spoken about. And that would be the SPY, that's the spider comparison to the S&P 500, the VOO, which is the Vanguard, and the IVV. So, it's a little bit concerning when you break it down. So what we're talking about here is, and anyone can do this. You can go to Yahoo Finance, which is where I'm looking right now, okay? And I'm going to the holding summary of the SPY. And when you think about the S&P 500 being 500 companies, 500 different stocks, okay? When you buy the SPY, the top 10 holdings will consume 26.8% of your total assets. So over a quarter of your investment is in the top 10 holdings, okay? Matter of fact, when you look at the top 5 or 6 holdings, you're at about 20%, okay? But what I see here is Microsoft is at 6%, Apple's at 5.78%, Amazon's 4.49%, Facebook is 2.1%, Google's combined a little over 3%, J&J or Johnson & Johnson, 1.44%, Berkshire Hathaway, 1.35%, that's the B class. Visa is 1.27%, and Procter & Gamble is 1.15%. So when you buy the SPY, you have 10 companies that are automatically over 25% of your entire portfolio. Now, if I go and I look at the VOO, I have a very similar mix, okay? 25.59% are 10 holdings, which also include Microsoft, Apple, Amazon, Facebook, Google, J&J, Berkshire, Visa, and Procter & Gamble. Now, the percentages are a little different. They own a little more of Visa than Procter & Gamble, but we're talking about, less than, whatever, 10 or 15 basis points here. The rest of the stuff is pretty much in line. When I go to IVV, okay, which is just the iShares version of the S&P 500, I have a very similar story, all pretty much the same, okay, but that's 26.9%. Now, all three of these say that when you invest, instantly, a quarter of your money is in 10 stocks. That doesn't give you really some kind of very composite-based, diversified exposure, in my opinion, to the S&P 500. Now, what's really funny is when I take a step in the other direction, and let's say I wanted to just own the tech sector, and I said, you called me and said, Ben, I really just want to own the NASDAQ. And a common NASDAQ ticker in the ETF world is QQQ, and I just want to compare the actual holding differences, okay? Now, the percentages are different, but the actual holdings show a very interesting similarity. Now, the top 10 holdings in the VOO I mentioned were Microsoft, Apple, Amazon, Google, and Facebook, okay? The first few holdings in the QQQ are Apple, Microsoft, Amazon, Facebook, Google. Okay, but this is meant to be a tech holding. Now, the difference really is, there is a difference, and the difference is that the top 10 holdings of the QQQ will actually amount to 54% of your holdings. So if you said to me, Ben, I want to really get the S&P 500, but I want to focus in tech, and I want to do a 50-50 split, and you told me buy the VOO and the QQQ, which are the S&P 500 and a NASDAQ-focused tech holding, you would be looking at having an overlap in Apple of your entire portfolio being 18%. That's amazing. I mean, you couldn't make a purchase for somebody at 18% in Apple in a brokerage account just buying stocks without getting a phone call or a notice from compliance.
So you're saying that we're fully diversified when we just when we buy both of those 50-50, right? And I'm being totally facetious here. So
yeah, no, we're totally joking. Yeah, I mean,
but that's the idea that people hold on to, right? And the misconception can be, if I buy SPY for the exposure to the S&P 500 index, the thought there is that, well, I'm going to own 500 companies, and that's going to be split up, 1/500th between each one of those. Or even if I don't, I feel the feeling can be, if I'm in something like that, I have a greater safety than I would if I were to go and buy, do my best to try to pick up 500 different stocks, or just, let's say, 100 different stocks or something like that. Or
yeah.
Because it's a composite, right? There's a whole bunch inside of this. But you're saying that there's 26% of that holding, 1/4 of that holding in 10 different companies.
And if you were to say, I want to do this, with the two different holdings here, for instance, I mean, you're looking at 30 or 40% of your entire portfolio broken up among essentially 15 companies, because there's a little bit of difference in the next few. Because when you go to the QQQ, you're looking at Intel, NVIDIA, Adobe, and PayPal. As soon as you get into the QQ, okay, well, those are 4 new holdings. That's a little bit more diversification. I mean, come on, this is kind of over the top problematic.
Mm-hmm. And then what happens if you go and you're looking at or following some market commentary out there that's saying that what are the top 4 companies to invest in for the next 10 years, and you're buying more possibly of any one of these holdings, and then you're getting yourself into 30% in Apple or something like that, without really understanding. You already own 18% if you did that 50-50 portfolio before of the SPY and the QQQ.
Yeah, it wouldn't be 18. It'd probably be, I actually should have said the math, it'd probably be more like 9, right? Because you're 50-50. So, but when you actually break it down, the overlay of these portfolios is horrendously bad. You shouldn't have this kind of exposure to one company or one scenario. I mean, look at Enron. I mean, Enron huge energy company, just total problems everywhere. I mean, we know Apple has a bunch of cash, but I mean, it wouldn't be the first major giant to report a major problem. And if all of a sudden 8, 10, 12%, I mean, if you have a ton of money in one stock, I mean, it's not diversified. It's not healthy. It's not probably how most people who own an index or what they believe to be diversified, trying to get some simple exposure, really brings them.
So this brings up a question that I would have as far as timeline. If we were to take a look at the S&P 500 over, now the numbers that I'm looking at here are June of 1980 to June of 2020, right? 40 years. If you say you're in the workforce for 40 years and you were investing in the S&P 500, what would you expect as far as a return from that, right? And that's one of the bigger challenges that we have when we get closer towards this 2020 and the end of that career of working. What is the exposure? What are you really looking at? And Ben was talking about that potentially being, on average, around a 50% drawdown in the index, which is then relying not on 500 companies necessarily, but roughly 10 holdings that are significantly weighted in there. So if you look at those numbers over that course of that time, you're right around 9% return. If you reinvest the dividends, you're roughly around 11%. And you can take a look at different corridors in that, and it changes the numbers somewhat, but that's where people's mindset goes. But the average investor really only gets around 2 to 4% for that same period of time. And that's information from Dalbar out there, third-party resource that we take a look at and try to compare numbers through. So in terms of you, how we care about you is helping you to understand what it is that you own and why and how much of it you should be in there. That's kind of the secret of that's our concern for you as the investor.
Seth, you bring up a great point, because sometimes we find investors are their worst enemy. I meet financial advisors that say I make more money for my clients than I do for myself, and we've laughed about that with people, and there's such an emotional stake inside investing your own money, and people get very nervous. They get very, very nervous, and they can't see the forest through the trees. And I like the concept of having someone else to bounce stuff off. I mean, obviously that's part of what we do, and that's who we are. And I want to say that I am not against index investing or passive investing. We use that. We use an active passive strategy quite a bit for a lot of people because we believe in the passive holdings, but we also believe that there is some intelligence behind some of this that can be, managed. And that's why, we utilize some of these pieces. But for most people, they say if you just buy and hold, you're just going to work out. Well, in some market time periods, you're absolutely correct. And then in other market time periods, active investing blows passive investing away. And we believe you can probably, maybe do a little bit better between utilizing both strategies, because we don't believe any one is correct. The world's not over. The market run's never going to end. So how does that work? I think at the same time, Fidelity had, one of their greats talk about how his portfolio had done phenomenal, but that his average investor was way below that return because they kept going in and out of his fund as if he didn't know what he was doing, So it's kind of funny because he was already actively managing it. Now, this is a common story inside of all of this, and I think John Hancock did a study, and they said, it's over 80% of people never rebalance or reallocate their 401k, and that's probably a lot due to either the idea of set it and forget it, that kind of concept of like, don't trade it because you're just going to cause problems. The market moves up on its own. And then there's also the idea that, I can buy these indice kind of investments and ride it for the long haul. Well, all of those things could be playing into that study, but we do find that people choose these investments day one, and then they never look at them again until they say, I need to retire and I got to go talk to a financial planner. And there's a real problem with that. So
you want to have exposure, right? That's one of the things that we come back to is you unless you are the kind of investor you could be, you only invest in real estate. Like you actively manage that real estate yourself. We know people that do that
all the time.
I only invest in bonds, right? That's that's one kind of an investor, and we recognize that. And we're not saying that this is the solution and all be all for everybody out there. Okay, that's wonderful if you know what you're doing, and if that's your bent and you go do that, wonderful. The average investor out there has the 401k, or they've built up this portfolio on the side. Why would you want to own the S&P 500? And how much of that? We would call it a core holding. For a lot of the portfolios that we're taking a look at, we would consider it in some portion or part something that we would want to participate in. And we can take that, again, that 40-year story of the person investing from the 40 years that they're in the workforce and reinvesting. We want to be a part of that story that has that 9% return, 11% return, or whatever, right, over time. So this is why we want to, but we also want to understand what's under the hood here and what are you actually participating in, right? And what are the caution here is if you're thinking one thing and not understanding how this vehicle operates, you can basically wind up in a car crash pretty quickly, right? You want to be able to stick with the program. You want to be able to build the roadmap. Want to be able to understand if you are 100% involved in the S&P 500 that you have, a quarter of those holdings that are held by 10 companies, and that the likelihood of something happening in the future where over a 2-year period of time you could have your holdings draw down 50%. You're okay with that because you have this bigger picture in front of you. And that helps keep you on track and engaged and doing what you need to do to have a successful outcome, which we call retirement for most people.
Yeah, that's a great point, Seth. And I think that's what we're talking about is the bubble. Everyone knows the story of the bubble when you talk about the market. They talk about the tech bubble, the real estate bubble, the market bubbles. I mean, it's the one that's going to burst. And I think when you have the S&P 500 index in probably any one of these, when you talk about even FANG stocks, and Netflix isn't even on any of the top 10 of these items, but when they talk about FANG, Facebook, Apple, Netflix, Google, Amazon, you just, the problem is if we have a tech bubble, your index investment just crashes because there's so much tech buried into the first 20% of your holdings. I mean, you could see a significant drop just in a major tech change across the board because so much of the S&P 500 too, as well, not just the top 10, are tech-based.
I'm going to throw another ticker out there, right, which is that Tesla ticker that we were talking about, which is a part of the story moving forward where you, just because I want to say this, you could have the Fat Mag is what it would be. Instead of the Fan Mag, you'd have a Fat Mag there.
Yeah, the Google. Yeah, I know. That was interesting. I did see that in that article that we had read in the one before. I think people don't understand this liability that they're taking on, this risk of the tech. I mean, tech grows and grows and grows. I mean, Amazon is like, it's trading at 100 its PE. I mean, when I look at, its price earnings, and I'm just saying to myself, I've had people say, well, you just have to ignore Amazon's PE, and it doesn't really matter because, it's always traded, it's never correlated to the PE properly with everyone else. It's still its price earnings. I mean, you can't just ignore some of this data and to ignore the fact that we might be a stay-at-home world, we might be in a tech-focused scenario, but we are seeing tech stocks having risen 100, 200, even 300, 400% since their lows in March. I mean, we have seen some crazy tech scenarios. But if we go back to a social society, they're not going to be necessarily where the investments are. And even if your tech bubble isn't necessarily a bubble, but it's a short fall, it's still going to pull back your portfolio in a more heavy manner than a properly weighted, properly diversified portfolio that we would completely engage all of our clients to look at.
So what are some of the advantages when you're taking a look at the S&P 500 as an investment and your portfolio? If you are younger in your investing, the beauty here is that you have time and that there's a simplicity to this, right? You're not going to have to go out. You can be an index investor, and you're not going to have to go out and manage the what's under the hood there. And because what was under the hood in 2000, right? Cisco was a huge part of the index at that point. No longer a story really as much as it was. And so there's going to be some rotating factors in the economy. And so the participation there is kind of done for you. And that's where people, we're preaching to this other side of the aisle here, where we don't want people to fall asleep, right? The younger investor can do a little bit more of that set it and forget it. And we would focus more on the activity, usually in that demographic of, hey, create a saving activity. Go ahead and dollar cost average, continue to buy into the market and buy into this index idea, because over time that's going to simplify your life. And we're going to turn around in 10 years and be looking at something that, if you were to manage that by yourself and doing buying and holding and selling and all those kind of activities, you probably are going to wind up being more of that 2 to 4% return person. And we want to have you on the upper end of that, right? We want to have a more successful story and more successful outcome that way. So there's some benefits there with the S&P that are really hard to recreate or duplicate on your own. And we get that.
You know, Seth, you bring up some really good points. And I think there's one thing that I was thinking about as you were saying that. When you look at the bond market and you look at the stock market, there's a lot of money there, okay? But what a lot of people don't realize is that the bond markets make up about $40 trillion, okay? The domestic stock market this is just U.S. numbers, is less than 20 trillion. So the stock market's less than half the size, a little over a third of what the bond market is. But as yields drop, as the bond yields drop, as interest rates go lower, folks, okay, people are going to find yield in the equity markets. Now, when a stock is providing, say, a 5% yield and a bond maybe pays a 4% yield, well, the reason people prefer bonds at 4% versus stocks at 5% is because as a bond investor, you are the first one that's going to be liquidated for the money. You're going to get your money back, okay? More likely than an equity investor or a stockholder. You are the last person in line to get paid if the company goes under. So people say, well, for that risk difference, I'm willing to take a little less money because I have less risk in the bond market. But if all of a sudden bonds are only paying 2% and that stock's paying 4 or 5%, and now you're talking about a major differential, people say that the yield outweighs the risk. That becomes a major attraction. And there's a lot of conversation about the bond market sliding into the stock market. But what does that do for our bond market? Because I'm not necessarily personally very concerned about it, because since our Fed has kept ourselves in a zero to positive yield perspective, a lot of money overseas where there's negative yields has been flying into the U.S. buying up our bonds. So it's been keeping our bond market quite afloat. But I do see a lot of U.S. investors sliding out of bonds, looking for yield, looking for opportunity in the equity space as the interest rates decline. It's kind of a normal kind of thinking. As interest rates go up, if you can take less risk and still hit your return, hey, why not, right? So that's a lot of what's going on here. And I think over the next number of years, whether that's 5, 10, 15, 20 years, I do think as long as these yields are low, I think we're going to see money moving out of the bond market and actually flying into the stock market, potentially pushing up the market. But as I talk about this, and Seth said I could bring this up on the show, so I'm going to do this, because when we talked about the Apple split, and you're talking about the general overall perspective of what's happening in the stock market, we look at these indices like the S&P 500 or the Dow to say, hey, the market's moving. Well, what's interesting about the S&P 500 is that a stock split really means nothing to it. But because the Dow is a price-weighted indice, okay, so it's the price of the stock actually is how it's weighted, a reverse stock split actually will impact the moving forward scenario of how the Dow creeps up. So with the Apple being, I think the number one price stock, in the Dow, as it grows, it has the largest impact on what the Dow reports as how much it goes up. Now, a lot of people don't know this. They look at it, well, it's 30 companies and so forth, but it's not just 30 companies. It's based on what their stock price is. So when Apple does a reverse split on their stock price, when Apple now grows, so if it was they're doing a 4-to-1, now it's trading around 450-ish, but let's say it was just a $400 stock and they do a reverse split 4-to-1, not a reverse split, but a split 4-to-1, now that you have 400 shares versus 100 shares in that scenario, but you have 1/4 the value to start with. Well, as that share price grows, it's going to impact the Dow Jones less. Now, it won't affect the S&P 500. It will still have the same correlation because they use the number of outstanding shares against that market cap. But in the Dow Jones, that impact is less. Now, if you were a conspiracy theorist, you'd say to yourself, well, for Apple, it's kind of opportune for it to do a reverse split right before an election because theoretically it would cause the Dow Jones to rise less as it continues to grow more. And that's kind of a scary ability to manipulate something that is probably the number one indice that people look at to see how the market's doing. If I asked somebody what the Dow is, they'd know. But if I asked them what the S&P was, they might not even have a clue what the number was. They wouldn't even know within 1,000 points of what the S&P was. And that's something to really be aware of.
So this makes me rethink our Dow 30 show. It was actually kind of a really fun show to go back and think about because not only was it, there's 30 stocks in the Dow, but we were speculating that the Dow was going to rise to 30,000. Maybe we need to walk that back a couple of years here with COVID.
I still think, Seth, I'm still Dow 30,000 end of this year, first quarter of next. I still believe that happens. With Apple doing this reverse stock split, it definitely makes it harder, right?
It does, yeah.
But
yeah.
Apple could still grow at the same mega pace it's been growing and have less impact on the Dow. And that's not something that people know.
It isn't. Yeah. And gosh, how many people really can even tell us the 30 in the Dow currently? And, frankly, it's not that important for you at the moment to know all of these things. The thing that's really important for you as an investor to know is you got to have a plan, people, because if you don't, you're just shooting from the hip. And historically, that's not going to get you close to target, right? You need to have this out there. You need to have this piece out there that says, this is what I want, and this is how I'm going to get there. Okay? So, in understanding that, we can start to take a look deeper into what it is that you have in your under the hood, in your car, in your how the vehicle that's getting you to the finish line here. And that's what's important to take away here is knowing those pieces. But first and foremost, you got to have a plan. That's what we do at Brayshaw Financial Group. We are planners. We sit down with you. We take the time to uncover who you are as an individual investor. What are your goals? Everything revolves around those pieces. And then really, where's your timeline? And what is your risk in all of this? And that helps put together the program that's going to help you get where you want to go. And believe it or not, somewhere in there, in some small part, you're probably going to see something like SPY, right? Or QQQ or IVV. I feel like when I say IVV, like I hear the Jackson 5 song pop into my head. Neither here nor there, folks, but that's what happens sometimes when you're saying these things over and over again. And it's fun. And it should be fun, and you should be able to grab this, and you should be able to take it home with you and feel really good about where you're headed. If you don't have that experience happening right now, give us a call. You can reach us at 855-226-8551 or info@yourmoneyontap.com. You're going to talk to Ben. You're going to talk to me. We're going to put a plan around your finances and your goals and help you get there. All right? And I can't tell you how fun that is to have those meetings and have those times with you. And we appreciate all the people that are listening to us here at Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. You can also find us at Facebook. We're at /3D Investing. We're also on Twitter at BFG_LLC. And as always, you can also find us at yourmoneyontap.com. moneyonTap.com. Thanks for listening. Thanks for liking our podcast. We appreciate you, and we can't wait to make it a great day and a great life with you here at Money on Tap.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.